Time to talk money this morning. Brent Wilsey from Wilsey Asset Management joins us now to talk about bonds and whether or not you should do funds or individual bonds. Brent, good morning. Great to see you as always.
Good morning.
Basically, you're going to talk and I'm going to try to keep up.
Yeah, and you're a little confused on that because people are confused about it. That's why I want to talk about it, is that people do feel, I don't want to be in stocks or too risky, so I don't go to bonds. But there's different bonds, and you get burned on bonds as well. And I do want to talk about briefly that last week we had the CPI come out, which is Consumer Price Index, which was good. That's a report on inflation. I want to point out that the PPI, which is Producer Price Index, was 1.3% increase year over year. The consumers was only up 3.2%. And that was a lot because of shelter cost. So inflation numbers are coming down. This is so important because not just for bonds and for equities, it appears the Fed is done raising rates. We now know where rates stand. So if you are a bond investor, you can understand that, okay, we don't have to worry about rates going up, because when rates go up, bonds go down. So then you have to choose which type of bonds do I do?
Okay, and what are the different types of bonds to choose from?
You have different ways of doing it. You have the mutual funds, the ETFs, which is kind of done for you. What's nice about those is that you have the ease of purchase. You buy this bond mutual fund or this ETF, all done for you. You do it and you forget about it. Diversification, you get that automatically when you do a mutual fund or ETF. You have many different bonds in there, so you're not worried if one bond defaults or goes bankrupt on some municipality. You're okay with that. And then also to reinvestment of dividends. The dividends that they get or the interest that they pay will be reinvested for you automatically.
Okay, so how do you know what bond is best for you?
Well, I mean, there's some cons to the mutual funds as well, and that is there's no guaranteed return of principal, because what happens, you put your money in and it never matures. So you're there for 20 years, it'll never mature. You always go with what the fund or the ETF is. There's a thing called net redemptions, which worries me, because if rates were to go up dramatically over the next 3, 4, 5 years, the price of bonds go down, people start redeeming their bonds or their mutual funds, the fund manager has to sell those bonds, which hurts the people that stayed in the fund. So when you're with a group of people, there could be problems called net redemptions, and then also to fees and commissions. Brokers can sell these, so they could have an upfront charge, a back-end charge, a higher asset management charge. You can get them directly from funds many times with no charges, but be careful when you're doing it. And many times people say, oh, they're free, don't worry about it. No, there's a fee backed in there somewhere where someone's getting paid for something.
All right, what else do we need to know?
Well, the individual bonds, that's the other option people can go to. And what you get with this is a guaranteed return of principal. You buy a 10-year bond, at the end of that 10 years, you are guaranteed to get your principal back based on where that bond's coming from. A municipality, corporation, U.S. government, whatever it is, you're guaranteed to get that back based on their ability to pay back. You have lower fees, no commissions many times because you're buying the individual bond, so that's a positive. And you own the debt. They're going to pay you back directly. There's no intermediate in between you. No one's going to charge you for doing it. You own that debt. You'll be paid back at maturity, whatever you loan them, $10,000, $50,000, whatever it is for that bond.
All right. You still doing the newsletter?
Still in the newsletter. I got to point out the cons, though.
Go for it.
Yeah, because the cons are, I don't want people to think bonds are great, because you have lack of diversification when you do it yourself. Because when you do it yourself, you don't have 10, 15, 20, 100 different bonds. You're all diversified, or not diversified, you're all into one. That one municipality goes under, you lose your money.
Right.
Also, too, the interest paid directly to you. So what that means, like, well, where do I invest that interest? You now have to find some place to invest that interest that you got every 6 months from that bond. And also, too, it's going to take a lot more of your time. You got to do the research. What type of bond? Do I do a high yield? Do I do corporate? Do I do government? Do I do tax-free? Do I, many different things. So it takes a lot more time, and to follow that bond. Because if things start going bad with that municipality or that corporation you loan the money to, you could lose your money. So it takes more research for the person doing the individual bonds versus the mutual funds. This is many times where an advisor can come in, a good advisor can come in and help you out through that. So I want to get that out for people.
Based on everything you say, I'm just avoiding bonds if I'm doing this. It's all pops and buzzes from here.
And I'm glad you said that, because people think it's so easy. It is not easy. I mean, there's so much to it, and you think it's easy because they don't know the whole thing. Have a little bit of information. Oh, this is easy. But there's so much information out there that you start looking into it. Oh my gosh, this is so confusing.
Right.
And it is. Don't feel bad about it.
Yeah. All right. So, newsletter? Newsletter,
yes. Newsletter goes out every Friday. We get so many compliments on that newsletter. Go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. Free newsletter. Goes out Friday at 5 o'clock. People will love it.
Free is good.
Free is good.
Really good. All right, Brent. Good seeing you, man. Thanks.
You're welcome.